Everyone, welcome to Liquidity Narrative and our classroom. So we started a topic trying to teach on understanding the smart money concept and data versus the retail trader. So we want to continue that to make it simple for people to understand. This channel is born out of passion to help other traders out there like me. Remember, we build this channel for traders who wants to understand the market structure, who want to understand liquidity and institutional price delivering. Um, Not you chasing the price, and we promise to give you the best. So the topic we've been treating, let's move on. So we've been talking about understanding the smart money concepts versus the retail trading concepts. And this is part two of it, trying to break it down and even easier. If you understand this, it will help you more in your trading. Like we said, if you look at the chart at the right hand side of this, look at the picture. Yes, we you can understand with me that most times retail trader builds their charts using all kinds of indicator. It may not be as bad as this seems, but then you see them putting up to 5, 4, 10 indicators, 3, 2 indicators in order just to get an understanding of what they're doing or take a trail. So why do most retail traders lose their money? Just like we said, because they are trading what they think they are seeing in the charts. They're looking at the chart and they think, okay, the indicator says overbought, oversold, and next to the jump in. They are trading in line with what they think they see in the chart, whereby institutions are not like that. The institution actually they are trading liquidity. They are looking out for something and that guides them. So today we are going to break down the difference again because we've done a video on it, but in clarity. I want us to understand more. That's why I'm bringing the part two of this with a clearer examples in our charts to make it simple. I will tell the story about a seminar that people attended, and then someone was actually giving that seminar about how to be a success. And then one of the attendees, one of the people that was there in the seminar, as the lecturer was giving the lecture about how to be a success, so he raised up his hand to ask a question. So the man like, okay, go on. He said something about this. He said, but this is not what we are being taught in the classroom. This is not what we are being taught on how to be a success, this. And then the lecturer asked the person, he said, your lecturer that taught you in the classroom, was he a millionaire in dollars? The person replied and said, no. The lecturer that taught you in the class, was he a millionaire in pounds? The student said, no. And then he said, the lecturer that taught you, does he have anything to show for what he taught you? The person replied and said, no. He said, I am a millionaire in dollars. I am a millionaire and a billionaire in pounds. And I'm teaching you how to be a success. Which one do you prefer? The classroom teaching or the one that I'm teaching you here? You can see me. I have a proof of what I'm teaching you. So in the same way, we've been taught a lot of things as retail trader. We've picked a lot of books and we've read through them. Most of them maybe trying to make out money out of them. But some people build this platform we are using, which we know or look at them as the smart money. So if there are something we should learn from them to aid us, why won't we go for it and learn that particular thing and use it for our trading? Sorry that I'm taking your time for this, but just to show you that is not about another retail teaching out there, but to show you that you can learn something. I have this passion to help others because when I was seeking for help, I was able to get that and I felt like, oh, people should know this. So that's the reason for this. So that being said, sorry for taking much of your time, but I thought that will help you. So let's focus back to why we are here. Like we said, the institutional traders, they are looking out for something. They're looking out for liquidity. They're not using any indicators. The indicators were built by people who are trying to make money. Did I say that indicators are wrong? No, not at all. So let's dive in. Today we are breaking down the difference between the two. the retail trading and that of the smart money trading. So here again, the question first we're going to ask ourselves, what is retail trading? What is the approach the retail trading are using? What is retail trading? And like we said, we've answered the question that is like an approach. Most beginners are taught online. Textbooks, people out there, they teach us this is the way to trade it. Follow this, follow that, follow that. Usually, these teachings is always revolve around using the RXI relative strength index, the MACD, the trend lines, the support, and that's the traditional support and resistance, or your candlestick pattern. I've learned all those. I've gone through them. And did I say that these tools are not useful or useless? No, not at all. Understand where I'm coming from. So most, like I said, but most retail traders, they use them reactively. They don't use them the way that the person, it can be of help to you. So I'm not eliminating it completely, but I'm saying you don't need to practically base your trading on them. The institution don't use those things. They often use as what they use, what you call breakout or break and retest. They use it just to grab liquidity. Let's watch this area. As you can see, the chart on your left hand side, you can see practically a trend line, and at some point we said trend lines require two or more lines, right? And then we want to see the line being broken and then a retest on that particular line. You can see practically this is a recent chart. You can go back to your USD JPY and see exactly this. The trend line was broken at this point and then it retests, but the market only consolidated within that zone and continued to go up. So the trend line fell in this particular instance. Then the other one, you look at the areas we called our natural or normal traditional resistance. We want to see price respecting this level. Most times it could actually work. Does it make it efficient? Not really. So you can see how price broke out of that area. And apparently some other people will still be waiting for this break also and retest of this particular resistance point for them to take a trade. Who knows what might happen after then. So look at the down part of this. We've put our RXI, then RSI, and then the MACD here. Every one of them is showing that the market is in overbought area that you should sell. Do you jump in because it has showed you you're in overbought? Both are corresponding that you're in overbought. Do you? So these are the things, question you should ask yourself. Most times they can work, most times they don't. Does not necessarily mean they have been working. Just like every other thing you do, at some point in life, you do things and they work, not because they are efficient or not. So I'm not saying that the indicators are useless. I'm saying, how about if you can learn trading without them? There's no better joy than looking at something, understanding how it works, and then go into your chart and use them and trade. Did I say you will not lose? No, I'm just saying the probability of your winning will be higher than the probability of you losing the market. That's how it works. So these are the reason why many traders get trapped, because many retail traders get trapped because they are using what they did not build and they did not understand and expecting it to work for them. It worked for some, and people out there show you a lot of things on the social media, how they use this. This is the best indicators. It works. It might work for them, but there are some things they know you don't know, and that's their edge. So how about you don't need all this if you learn the naked chart and use it to your own advantage? So don't approach the markets as a retail trading approach. No, we are being taught so, but there's something better for you. What's that? Let's continue. So after having said that about the retail trading, we are now looking at what the smart money concept is all about. So first, it's not just another word, it's not just another language for price action trading. No, it's much more than that. These are like banks, the large institutions, the hedge fund, all these people. They, they are the one using those. That's why we call them the smart money concept. Apparently, it's based on understanding how institutions move. Remember, all those things we are doing, the chart you're looking at is a programmed language, so it can be decoded and they know exactly what they're doing. Somebody built it up, it didn't fall from the sky. So the banks, the large market participants, they need liquidity to enter and exit positions. They need liquidity to enter and exit positions. So instead of asking yourself, where should I buy as a retail trading or a retail trader, the smart money always asks, where are traders trapped? Where are stop losses resting? Where is price likely to engineer to move? If you understand this, it will change your entire perspective on the market. So look at the chart on your left-hand side. You can bear me witness that if you're a retail trader, most of the times your stop losses are based on those lows, equal lows, where we call support zones. But look at how the market ran down and took out all those. See the huge running before the market reversed and continue in each direction. That's smart money grabbing liquidity. Like we said, they use it to enter their trade. They also use it to exit position. Probably smart money has short this trade. They know exactly they're going to buy at this level. So, and they know exactly that we place, or the retail trading people place their stop losses there. So it's going to trap you in, and that will be it. You are losing, but they are gaining. So that's what smart money concept is all about. Someone apparently said, if you want to catch a criminal, you have to think like them. I remember that book is called Criminal Minds. Yes. He said, if you want to catch a criminal, you have to think like them. So if you want to get things the way the smart monies are getting them, you have to think like them. You have to tread like them. You have to study what they are studying and kind of be a part of the success that they are getting. Just take advantage of what they have already, the footprint they are leaving in the market, to be in the market and get something out of the market. So what next for us? Let's move on. So the next things we're looking about now, we've talked about how they require liquidity in order to enter and exit the market. So the question is, what's the role of the liquidity? This we've also treated in the part one of this particular video on understanding smart money concept. So what is the role of liquidity? We also listed here, liquidity is one of the most important concepts in trading. It is one of the most important concepts in trading. If you understand it, it will aid your trading. It will be an added advantage. It will give you an edge over those who don't know it, because that is what the smart money requires. Liquidity exits where trader place their stop losses. We've talked about that, like the common areas, the area we call our resistance, that's highs, equal highs, the areas we look at as supports, which is lows, equal lows. All these areas will be taught that price will respect those areas. It can be your previous day's highs, previous day's low. It can be a section high. It can be your trend line, like those who trade trend line break and retest. Those areas liquidity resides there. So if you look at the chart, just like we've said, on our left hand side, you can see that liquidity, this can also be the first chart is showing like an equal lows, right? So you have seen almost 2 to 3, but liquidity came back, took them out. If you draw a trend line, which we'll see in our next slide, if you draw a trend line, liquidity reside there. Price will also come back and take those liquidity, just like we've seen before. Okay, let's go back and see. Okay, so this liquidity reside on those areas. So price is constantly drawing towards those areas. Why? Because institutions needs them all to fill their position, and the market seeks liquidity first. Market has a place it was going, which we also look at as our drawn liquidity, but markets need liquidity to get to those draws. Something is drawing the markets. So those are the areas we are looking at. Those are the role of liquidity, and the institutions needs them in order to fill their positions. If you understand the role of liquidity, it will help you to trade better and not just to be the liquidity yourself. So let's move on. The next, how retail traders get trapped. Okay, let's say price is trading upward, just like you said here, and the market broke out of this resistance, and the retail trader like, oh, this is a break and retest. So he took a buy, and suddenly the market reverses and take the person up. So retail trader sees resistance has been broken, and then they enter long. Place stop loss below the recent lows, as you can see in this particular image, and this is also a recent chart. Today is the 1st of June. Go back to your chart on US Tech Nasdaq and look at it, and you'll see exactly what I was talking about. So they play their stop loss below those. Institution knows this. The market does not know that you're there, but institutions know this. I know that's where we place it. It doesn't know you as a person that you are there. So price apparently pushes higher and encourage more buyers to be in the market, and suddenly and takes out. That move is called a liquidity sweep. After liquidity is collected, the real moves begins. So you see, these are the things we see every day in the markets. So what next? This is how the retail traders are being trapped in the market. They join the market when the market is about reversing, and then they're being taken out. So moving on then, um, so the retail trade, like we said, they are being trapped. This is the work of the smart money. You can see it, resistance being taken, and then price reverses, took out all the stop losses, and price reached to where it was seeking liquidity, took liquidity before reversing. This is the work of smart money concepts. If you understand the smart money concepts, you will enjoy your trading. You will not be the liquidity. Rather, you will take advantage of the liquidity and run your trade. So, moving on, next. So, these are the things you required to aid you in your trading to understand better. One of the things is market structure. Market structure, like we said, smart money trade relying heavily on market structure. And what are the market structure? Let's say, for instance, the here we've already dropped out something. If the market is creating a higher highs and a higher lows, we are suggesting that the market is a bullish structure. So if the market is creating a lower highs and lower lows, we suggest that the structure is a bearish structure. But the key understanding is this, the break of structure and the market structure shifts. So when the break of structure has happened, we know that it's a continuation of a particular trend. But when we have a market structure shifts, sometimes it might signal there is a potential, like we use the word potential reversal. Does not always mean that, but it have to be at a key particular level for you to say, okay, this is a reversal. That's why we use the word potential reversal. So reversal. So the structure helps traders to align with a narrative. And after that, when you'll be able to understand your market strategy, the next thing you're going to be looking into is your displacement and then fair value gap. We want to see the market display. What does we mean? Like a sharp move away from that particular area. Let's look at it. So we've talked about the displacement and fair value gap. That's another major concepts in smart money concept. So this is another area you have to look at. Displacement is, like I said, is a aggressive institutional move. Like I said, is a sharp move away from that area. It have to occur. They don't stand alone. They are being joined together. Like market have to be a particular key level. And when the displacement comes in, it gives you an idea that institutional are there. So like you can see in the picture, market got to this level after everything. It displayed a huge move to the downside, created a fair value gap, other blocks, they are all there. So that's a large impulsive candle, strong momentum, fast delivering. It wasn't crawling. So you can see how the candle moved away from that particular area. These usually reveal an intent. There is something is about to happen. Your duty is to watch those areas and see what is going to happen. So when displacement occurs, it often creates behind it fair value gaps. So sometimes people use fair value gap without understanding much. Yes. And these are imbalances in price delivering, and price frequently retreats into those areas before it could continue in its original direction. As you can see in the image at your left hand side, that retracement can provide a high probability entrance if you know what you're doing. Does it mean that every every huge move is a displacement, or every fair value gap is tradable? No, it depends on a particular place or the key level where this thing is occurring. So the next thing that the smart money uses, all these things we are talking about, is what the smart money uses. We've talked about the market structure, we've talked about displacement and fair value gap. So the next thing, which all of you knows, is the order block. So this is the order block, which is also an institutional zone. As you can see in this chart also, the market ran into a particular key level which we did not include in this study. We mapped it out, created an order block, displayed, and then returned back into the fair value gap and ran down. And later on, the market returned back to the order block also to give a second chance running the liquidity that it has created on the fair value gap, and run a liquidity out of grab liquidity for those who have already moved their stop loss to that area. Liquidity run into the order block and then continue to go down. So these areas can act as a point of reaction when aligned with liquidity structure. Key levels also. Remember this, order block don't work alone, and it means nothing without a narrative. That's why we said narrative is everything. Do not just trade order block for trading sake. Do not just trade fair value gap for trading sake. Do not just trade liquidity runs for liquidity sake. There are narrative that are behind them, and that's the reason we bring this classroom to you to make it even more educative, more enlightening, not just talking, but the practical charts of those areas. So that's the real difference of what we can understand, how the smart money are trading, what they uses instead of using indicators, instead of using the relative strength, instead of using MACD, wave, Bollinger Bands. They are looking at some things. They are looking at structure. They are looking at displacement. They are looking at order block. They are looking at liquidity runs, liquidity grab. Those are the things. They are looking at price action to help them. They are looking at narrative. Narrative is everything. What is the market saying? What is the story behind what the market is doing at that particular point in time? So we decided to bring this to the classroom to make it easier for you. Don't trade like a retail trader, trade like a smart money. So what's the real difference? Right. As you can see, we've been able to say a lot about the smart money. We've given an example chart. Your duty is to go back to your chart, look into your charts, study them with what has been said there, take notes, try to look into them and see how they works. That's your own aspect of this. Take a note, go back to your chart, study them. Where you don't understand, you can drop in the comment section. You can say, can you elaborate more on this? Can you be able to explain more on this? I promise, once I have the opportunity, I will get back to that. I want to derive joy seeing people do well in this, but it needs time, it needs your dedication, it needs focus, it needs discipline. Can you create that time? I'll create a time to do my teaching and my analysis, but create time to study, to learn, and to use it for your own advantage. So what's the real difference? The retail traders, they react emotionally. Yes. Oh, it's buying. All of us jump into the market and something changes. But smart money traders interpret price delivering. What is price doing? Where is price at this moment? Where are we looking at where the liquidity lies? They don't chase candles like the retail traders are doing. Rather, they wait for liquidity to be taken first. They wait for the draw on liquidity to be reached first if it's closer. But retail trader, they focus on indicators because we want to make it quick. We want to make it suddenly. Forget about the things you see on the social media, the cars, the buildings, the chains. No. Focus on building yourself in the real way, and then you'll be happy that you do. Because those people that you're seeing and showing themselves on the social media may not apparently be what they claim to be. There is more to life than what you see. The smart money, they focus on the market intents, not on the indicators intents. That is the difference. If you are trading with the smart money, you will get what the smart money are getting. If you are trading with the retail tradings or traders, you will get exactly what they are getting. So that having been said, what is it? If you want to prove, this is my advice. If you want to improve as a trader, stop asking the question, where do I enter? Start asking the question, where is liquidity? What is the narrative? What is the market saying? What is price delivering to us? What is drawing price to it? Because the market is engineered around liquidity. And that's what we always teach you here in Liquidity Narrative. Map liquidity first. Take your time to map out where the liquidity lies. And that is why we said we are not predicting price. We are just choosing to follow structure over speculation. I'll ask you to do this. Subscribe to the channel, follow, because we drop our liquidity map, narrative map on Sundays against before the week resume to map out where liquidity lies, which we've already done. You can go back and check the videos on that for this week. For this week, we map out those liquidities, where liquidity lies and what we expect the market to do. As you can see on Sundays, then within Tuesdays and Thursdays, we drop courses that will help you to learn and understand how to go about this. And then after the week, some of the end of the trading, we'll be able to do our accountability review on what has happened within the week. I may not drop it every week, not because I don't want to, but because maybe I may not have that time to do the review. But all analysis and the liquidity narrative is in the channel to prove itself. Subscribe, share, comment, whatever you want to and you don't understand, and I promise I will get back to you. This is Liquidity Narrative Classroom, trying to bring everything to you. Thank you for being this patient, and I wish you the best. Keep learning, keep studying. At the end of the time, you'll be grateful that you do. Till I see you next time, have a lovely time, and thank you.